Hey traders, and welcome to the new video. A lot of traders rely on the indicators for getting buy or sell signals in the chart of the market. But the thing that makes the profitable traders different from the others is the way they use the indicators on the chart. The indicators can help you become profitable once you know the proper way to use it on your chart. If you are interested in the topics like this, then like the video and be sure to subscribe to the channel. There are two types of the indicators, which are lagging indicators and leading indicators. The lagging indicators provides the signal after the price makes the movement, and the leading indicators provides the signal before the price makes the movement. Now here there is one thing that you must remember. Don't trust any indicator blindly, as the market is unpredictable and anything can happen at any time. That's because the market runs on the emotions of the buyers and sellers. If there's some bad news about a stock, the buyers of it may turn to become sellers of that due to fear of losing money. So in this video, we would discuss about one of the lagging indicator, which is Relative Strength Index, also known as RSI. The RSI is one of the most used indicator by the traders, and hence we would discuss about the RSI indicator in this video, and at the end of the video, we would reveal the two simple and effective RSI strategy, which would help you in becoming a profitable trader. Let us look at some of the basics of the RSI indicator. Firstly, let us see what is the RSI indicator. The RSI is a momentum oscillator that measures speed and magnitude of the security's recent price changes. The RSI oscillator moves between the range of 0 to 100 and is represented in the form of lines. When the RSI line goes below the level of 30, the asset is said to be in the oversold. Like on this chart, the RSI indicator went below the 30 level, and because of that, the price is considered cheap at this point. And likewise, when the RSI line goes above the level of 70, the stock is said to be in the overbought. Like in this case, the market went above the 70 level, and hence, the price is considered expensive at this point. Most of the traders uses the RSI indicator in the traditional way, which may lead to profits at some time, but not every time. Now let us see how the traders uses the RSI indicator on the chart, which is also called the traditional way. So here we have the chart where the market is making higher highs and higher lows, which indicates of market being in an uptrend. And as the market is in an uptrend, we would look out at the areas from which we can go long into the market. Here we have also taken the RSI indicator. Now when the RSI line goes below the 30 level, the traders usually go long as they believe that this asset is oversold. And thus, the price is cheap at this point. Let's go long from this point and check whether using the RSI indicator in a traditional way would make us profits or not. The market went below, and hence, we made loss from our trade. Now if we see this chart on the higher time frame, we can clearly see that the overall trend of the market is bearish, and the upward movement that we saw on the lower time frame was the pullback of the market. And just because the RSI is indicating oversold, it doesn't mean that it cannot get more oversold. In the heavily trending bearish market, the RSI line can stay at the oversold for a longer time. If you go long into the market by only seeing the RSI indicator, then you may end up making significant losses. Don't expect from the market to make a reversal at this RSI's oversold or overbought areas each and every time. Same thing happens during the overbought phase. And that's the reason behind we denying you to use the RSI indicator in this way. There is an essential thing about the RSI indicator that you must know. During the trending bullish market, you should avoid these overbought levels of the RSI indicator. And likewise, you should avoid the oversold levels during the trending bearish market. Remembering this thing would save you from the significant losses. As the market is unpredictable, using the RSI indicator in the traditional way can be very risky and can also lead to significant losses at times, just like we had in the recent example. The lagging indicators like the RSI and MACD provides fake signals also at times. So we could not trust these indicators blindly. Now what's the solution of this? This thing can be resolved by using these indicators in conjunction with the other technical tools into the chart. The lagging indicators, when used in conjunction with the other tools, provides a splendid result of our trades. This is what our strategy is all about. Now let us move to the first strategy of the RSI indicator. So, in this strategy, we would use the divergences. The divergences occurs when price moves in the opposite direction of the RSI. The divergences indicates that the current price trend is weakening and a new trend may start very soon. There are two types of divergences which are formed into the market. The first one is the bearish divergence and the second one is the bullish divergence. The bullish divergence occurs when the price is making lower lows, but the RSI is making higher lows. The bullish divergence indicates that the current price trend, which is bearish, is weakening, and hence an uptrend can start very soon. Likewise, the bearish divergence occurs when the price is making higher highs, but the RSI is making higher lows. This indicates that the buyers are weakening and a downtrend may start soon. Now that we have learned about the divergences, let us move to its strategy. So, here on this chart, we have the market making higher highs and higher lows, which indicates of market being in an uptrend. Market is currently making smaller impulsive moves and bigger corrective moves. This indicates that the current market trend is weakening and a new trend may start very soon. The sellers are increasing and the buyers are weakening. Now let's see what is going on at the RSI indicator. On the RSI indicator, the RSI line is making lower highs, but the price is making higher highs. By seeing this, we can conclude that a bearish divergence is being formed into the market. This is called a bearish divergence because the price is continuing to go upwards, but the RSI indicator is indicating that the current market trend is weakening and a new trend may start very soon. And hence, we would go short into the market from this point. The stop loss of our trade would be above this recent high, and the target of our trade would be 3 times the stop loss. Now let's see what happens next. The market started going downside and hence, it helped us in making nice profits. The stop loss is a must when initiating long or short trades into the market. It's not possible that every time the strategy would work. And in case if it doesn't work, the stop loss is there to save you from making significant losses. Now let us see another example of this strategy so that you can understand it properly. So here we have the market making lower highs and lower lows. This indicates of market being in a bearish trend currently. The current market trend, which is bearish trend, is seen weakening. It's because the market is making smaller impulsive moves and bigger corrective moves. And this clearly signals that the sellers are getting weaker and the buyers are trying to become dominant. The price is making lower lows, but the RSI line is making higher lows. This is what we call the bullish divergence. This indicates that the current market trend is weakening and a new trend would start soon. The market also responded to this by making some bullish candles into the chart. After seeing this, we would enter long into the market from this point. The stop loss would remain below this recent low, and the target of our trade would remain at 3 times the stop loss. The market started going above, which is why we made nice profits through our trade. Now let us move on to the second strategy of the RSI indicator. In this strategy, we would use key levels in conjunction with the RSI indicator. And also, we would use 2 time frames in this strategy. Let us understand this strategy through an example. So here we have the chart of the market where it is making lower highs and lower lows. This indicates that the market is in the downtrend phase currently. This is the daily time frame chart. The market has made a resistance zone at this level as it rejected this zone twice. And thus, we can expect of doing so for the 3rd time also. But we would not go short into the market just by seeing this. And instead, we would wait for the market to give out a confirmation. For getting the confirmation and then taking entry, we would switch to the lower time frame, which is 4-hour time frame in this case. So on the 4-hour time frame, we can see that the market has made some bearish candles which broke this trend line formed below the price. And also, we can see that the RSI line and the price has made a bearish divergence. Now at this point, we have got two confirmations from the market, and thus we can call this area as an area of confluence. We would go short from this point. The stop loss would remain above this recent highs, and the target would be at 1:3 risk to reward ratio. Let's see what the market does next. The price continued to drop, which helped us in making significant profits from the market. Same thing happens while taking long trades into the bullish phase of the market. This brings us to the end of this video. So, in this video, we learned two simple and effective strategies, which would help you in making significant profits from the market. But we recommend you to backtest this strategy before using it out in your real-time trading. Now, before we end this video, if you liked our content, be sure to like our video and don't forget to subscribe to our channel so that you don't miss any of our upcoming videos.